food prices have been on a steady rise.
That the cost of food and other basic commodities have shot up sharply.
Half of your income going to just food alone is a bit scary.
As time passes, money will lose its value because of something we call inflation. In 2017, a 2-kilogram packet of maize flour cost about 90 shillings. Fast forward in 2023, the price rose to 230 shillings, nearly 3 times as much. Most East African countries, including Kenya, aim for an inflation rate between 20% to 25% annually. This number is how much value the money you have stored up in banks loses every year, meaning that saving all your money in a bank account actually becomes a problem over time. And that's when you are presented with this term, investing. The idea of using your money to make more money to beat this rate of inflation. You've probably heard about the stock market and how it's one of the easiest way to invest your money. But what even is the stock market? How do I even begin investing in it? And is it truly profitable as people make it seem?
We are live at the trading floor of the Nairobi Securities Exchange.
As the Nairobi Securities Exchange marked a historic step by launching it.
The term stock market is simply several exchanges in which shares of publicly held companies are bought and sold. Such financial activities are conducted through formal exchanges and via over-the-counter marketplaces, operating under predefined regulations. This definition begs the question, what are stocks? A stock or a share, both terms are used interchangeably to mean the same thing, represents a partial ownership in a company. If a company Y has 20 shares, all owned by the owner, then the owner owns 100% of the company. If he or she owns 10 shares, then they own essentially 50% of the company, and so on. Once you own a company share, however small it is, you become a shareholder. But then you may ask yourself, why would someone decide to sell shares in their company? Imagine for a moment that you own a particular company. For years, you've been enjoying significant sales, and now you feel the need to expand your business. There are many ways you can do this. 1, you can go to the bank and borrow a loan, but that means repaying the money with huge interests. Sometimes the bank may even deny you the loan in the first place. So another option is by issuing or selling company shares to either friends or the public. Selling to the public is always done through an initial public offering, a going public process. In essence, going public means that the company's ownership is transitioning from private ownership to public ownership. Here, you issue stocks, which are also known as equity or equities.
Now, on the Nairobi Securities Exchange, initial public offer has generated investor interest with...
You got to raise capital, and you do it through raising equity in the IPO process.
You may recall that stock represents ownership. As an owner, you are entitled to all the rights and responsibilities of a business owner. In a publicly traded company, your responsibilities are limited to financial commitment to the company, the amount you paid for your shares of stock. Your worst-case scenario is that the company becomes insolvent and your stock becomes worthless. However, no one can predict the market. As the company makes money, the board of directors has a choice to make. Do they give the stockholders their share of the profits, or do they keep the profits in the business with the intent of growing and expanding the company? If profits are kept in the business, the accounts call them retained earnings. If they are distributed to stockholders, then they are called dividends. More often, however, a bird in the hand is better than 2 in the bush. This means that shareholders commonly prefer dividends, which is usually paid in cash as a share of company's earnings.